So just some final thoughts before we move on to inventory. Inventory is really important. Um, some of the inventory stuff is going to be really practical, and you might sort of see it like you guys already might know things related to like FIFO, sorry, um, first in first out, as well as like if you guys are more related to like the logistics side of it, you guys might and like buying, you guys might see things like in regards to like um, fob, as in like when it gets on the truck. You guys might already know a lot about inventory. Like for example, like you guys might be doing it already, but you guys just might not know what the word is for it. Like you guys might not know that it's called periodic, but like you guys already might be doing that. You know, so like some of this stuff, like you guys might already be doing it. You guys just don't know the words for it, the terms for it. So before we move on to inventory, although like we're gonna probably go back in accounting, intermediate accounting too, because like, and I'll make another video after this to talk about a different topic, but like, um, we're just gonna talk about like this bad debt expense, and also like that's just like one really important thing about accounting in particular. Like accounting itself, like there's gonna be like things related to like managerial, there's gonna be stuff related to cost, there's gonna be stuff related to tax, there's gonna be stuff related to audit, there's gonna be stuff related to like information systems, you know, there's gonna be stuff related to gap. Um, but like the way that these journal entries are written based off of gap and the way like these based off of FASB and SEC and like how these incorporate these business stuff like the business law and the way they're set up. Like you guys might already see like a lot of this. You guys might already know a lot about this stuff. But like pretty much like this account receivable, because although not necessarily the note receivable or the notes payable or like the bonds payable or bonds receivables, they're not really necessarily like created for the bad debt expense and allowance for doubtful accounts. Like these, the bad debt expense and the allowance for doubtful accounts is really for accounts receivables. Um, from what I know, not necessarily you're gonna see like bad debt expense and the allowance for doubtful accounts for bonds and notes. If the bondee doesn't pay their bond or like their note, I don't really think that it's going to be related to bad debt expense, but I could be wrong here. But essentially, because you're not really going to be seeing like credit sales using like a bond, like that's a little too long of a time frame for these notes, for these bonds. You might see it with a note, like if it's a really large purchase, so you might see a bad debt expense for a note. But if it's like a really short-term note, like a few months, and because like most of the account receivables, these are sort of like internal IOUs, like these ARs, and that's why there's not really like a market rate per se for these for these ARs, like these account receivables and account payables. There's not going to be like an interest rate because like it's such a short term thing. Like these ARs, they have terms of like 10 days if they want to get a discount, but like otherwise, so like 110, that 30, like otherwise these ARs have to actually get paid out within 30 days. Like they have to be paid within 30 days or 45 days typically. So you have to see like this have to be paid being paid off by 10 days to get that discount. Um, but like the whole point of this is that these companies operate on credit sales because like they have like a business credit number. They have a bit of credit score, you know, and like why would they not use their credit? You know, because like that would free up a lot of their cash for other things like that more important needs like salaries payable. They and then they could sort of operate like in the future, like they would not be like limited to the cash they have on hand. Rather, they would sort of like operate on cash and credit. And so then like they're able to leverage credit, as in like when it says credit, it could be like for example, an AR based off like the suppliers. They are like giving each other IOUs and like really small amounts of credit, like a tab. If you guys go to a bar or something, you guys get tabs in the bar. Kind of like that for a really short term, for a really short period of time. But most of the time, like the majority of the time, these companies are operating on credit. Whether it's like a really short term like AR, you know, based off of like uh, sort of like internal like credit systems that are like between suppliers and companies, or if it's like sort of like a note or a bond. Okay, so like the whole point of this system, like the whole point of the credit system, is to sort of like allow companies to have leverage. Really, that's like one of the main reasons why credit exists is because of is leverage. Not that they have to have leverage, but having this leverage allows companies to operate and generate more profit. You know, so like because of their ability to have leverage, they're able to do things that they normally wouldn't be able to do just based off the cash they have on hand. Um, so because of this, they have to use like a accrual method, which is like a different way of like recording these transactions. Like for example, these transactions could happen um, like it could be like when it gets paid out is when it gets recorded rather than like the moment that transaction happens. Okay, almost all of these businesses are using accrual rather than cash based because like uh, although there are some companies out there, some businesses that operate purely on cash. And so, like, if they do really purely operate on cash, because some of these businesses do exist, then they wouldn't have an allowance for doubtful accounts, and they wouldn't have bad debt expense, and they wouldn't have like the reality of like some of these ARs, like some of these like accounts not being collectible. Okay, so like they have to create this allowance. I mean, they don't have to, but like, for example, they could, um, well, that's just the way the gap works. Is like this allowance for doubtful accounts and this bad debt expense. It just allows them to sort of like prepare ahead of time because like this number could be quite large, like this bad debt expense. Um, so rather than like having it be like really confusing and like throughout the year, like finding out, oh, this account didn't collect, this account didn't collect. Instead, they have like this ahead of time allowance for the uncollected, the allowance for doubtful accounts. And like it comes out of bad debt expense, which is a liability. So like they estimate these percentages of uncollectible accounts based on the risk factors of the businesses. So like sometimes these like these the percentage of the uncollectible accounts could be quite large. For example, like 10% of the AR might not end up being collectible. So like it really depends on the business itself. There's like a lot of reasons why certain businesses might allocate a larger allowance for doubtful accounts. Okay, but it's safe to assume that any business would prefer to operate on credit for many, many reasons. Like one, leverage; two, discounts, as in like they're the ones getting the discount because they're these ARs, they have like terms about like discounts. Um, if they pay with credit, they actually get a discount rather than paying with cash, actually. But that doesn't necessarily mean 100% of the time they would be getting a discount or not. But like the thing that to think about, and I'm gonna try to keep this video short, is that the AR, the accounts receivable, is like this really short-term credit lending system. Sort of, it could be internal, and there's like a system that they use, like 110 net 30. So like if you pay within 10 days, you get a 1% discount, right? But the thing that's confusing is that there's like these notes and these bonds. So like a note is like a short-term bond. Basically, like a note could be like less than a year. Sometimes it could be a few weeks. It could be like a few months. And like pretty much what we're gonna have to talk about in the future is about the discount on these notes, on these bonds. Pretty much if the market rate is higher than the issue rate, and like there's like this issue rate that could be zero interest or non-interest bearing for whatever reason. For a reason, they've been issued at zero interest, or like these notes have no interest at all, but they might have implicit value, implicit interest, as in like even though they've been issued at 0% or no interest, they still have like this implicit value, so to speak, that is given to them by the government sometimes. So like technically, like it's kind of like a market value in a way. So these notes could still be issued at a discount because like the government, for example, could um, pay for these. So like there's like all these different notes and these bonds, like treasury notes, treasury bonds, junk bonds. There's like so many different things, but like essentially, this is the way you would record these things. Okay, so like when the market rate or like the implicit rate, whatever, is higher than that issue rate, these are going to be issued out at a discount. So like the thing to really this is like one of the things that is just so confusing to understand is like the discount. Like for example, if it's account receivable with the terms 110, if you pay before 10 days, you get a 1% discount, right? As in like um, you would have to pay less. Like if you guys are paying with AP, let me try to show you guys real quick what I mean. Um, like for example, like let's say you guys have like a note, an AR, right? You guys take out an AR of 100,000, and the terms are like 110 net 30. Okay, so like, well, the thing is, there's two sides of this equation. There's AR and there's AP. So like, for example, you're the company that borrows on AP, right? And then there's the company that sells on AR, right? You guys should understand what I'm saying. Like, so like, what would happen is that, for example, if this company that borrows on AP accounts payable, let's say they took out like 100,000. Okay, so like, it could be cash, for example, but they most likely wouldn't receive cash unless it was a note or a bond. Really, notes and bonds are really for like cash to borrow money. AP is sort of like for like inventory, really, is what, or goods. Okay, so like they would get like 100,000 worth of goods if they are using the gross method. You know, if they're using the gross method, that's how you write it. If they're using the net method, for example, if it is 1%, if they do in fact pay before the 10 days, you know, then they would in fact get like that discount. So like 99,000, for example, if it was a net method, you know, discount on AP, right? It's 1,000, and they would have AP of 100,000. Well, they would actually receive 100,000. Sorry, they would only have the AP of 9. Is that true? Hold on. Use the net method. Of an AP. I'm pretty sure it's gonna be so. Yeah. Wait, no. Hmm. Okay, well, yeah. So like the AP, they get the discount. Um, the company that borrows on AP gets the discount. So like 99,000, and the AP would be 99,000. Okay, the company that sells on AR, for example, like it would be like accounts receivable, inventory, goods. Like you would really think that, for example, the 100,000, well, actually it'd be 9,000. It really depends on whether it's net or gross, but pretty much like they would receive like whatever, you know, the discount of 1,000. So like this is if it was AP, like I said, like if this was like accounts receivable, accounts payable, these are like short-term, like 10-day, 30 days repayments for inventory or goods. But if it's for like a note or a bond, and this is like a really important topic that we'll probably go over in accounting too. If the market rate, because there's no interest rate on AP. So like that's the thing that's kind of hard to understand, is that there's not going to be an interest rate on AP or on AR. There's no interest rate on this. So there's not going to be a discount per se, or like a premium similar to a bond or a note. So like a discount would mean like, yeah, like you would get a discount on like, like that's pretty obvious for us. Like we can't understand like what it means to get a discount on this stuff, right? But like the thing is, if you guys are thinking about like notes and bonds, a note, if there's a discount on a note, like for example, if the market value is higher than the issued value of a note or a bond, the discount is given on the side of the bonder. Okay. I know that's kind of hard to understand. So like, let's say the company borrows cash with a note payable. Okay. And then there's the company that lends cash with a note receivable, right? Because they're both going to have to write these journal entries for what happened. So if there is a discount, as in like the market rate is larger than the issued rate, okay? That's like something to just remember, that otherwise it would be a premium. A premium is when the issue rate is higher than the market rate. So if there is a discount, what that means is like, because like you guys have to like put yourselves in the shoes of the investor, as in the person that's lending money. I know it's really hard to understand, but you guys have to think about it being in the sense of like, oh, like I'm gonna lend you the money, right? I'm an investor and I'm gonna lend you money. You guys have to put yourselves in those shoes. So like, if the market rate is higher than the issued rate, then the discount is actually on the side of the investor, as in like the discount is actually for the borrower. The lender. The lender is the one getting the discount, not the borrower. I know it's so confusing. You guys have to like really put yourselves in the shoes. It's like you guys have to think about it in a different way. So like if there is a discount, if the market rate is larger than the issued rate, the company that borrows cash with a note payable would actually receive less cash and have to pay back more. Like, and then the company that lends the cash and they have their notes receivable, they would have to give out less cash and receive the same amount. So like, let's say that there's a note payable, right? Well, they receive cash. Like, let's say they receive cash 100,000 of 90,000, and then the discount on the NP of 10,000, the notes payable itself, the NP would actually be 100,000. Okay, and then for on the other end of it, like the NR, they would still consider the NR to be 100,000, and the discount would be 10,000. And then the cash they had to actually give out was actually only 90,000. You guys see? So the company that lended the cash with the note receivable is actually the one getting the discount, not the company that borrowed the cash with the notes payable. Okay, So like those are like some of the things to think about. I'm gonna make another video in a minute talking about this one other topic, but that's just something really important to know. If you guys have any questions, guys, feel free to reach out to me. Thank you.